up next, we've got Vanita Godino, who's CEO and Managing Director of Financial Resilience Australia. Could you just kick off by just giving us a bit of background on what it is you do?
Sure. So I actually put that in on my first slide. Is it showing up now? You know my technology.
Perfect.
Yeah, we can see everything perfectly.
Thanks so much, guys. So, to give you a background of what I've been doing, I just thought I'd pop it on a slide. So it looks like a bit of a crazy mess because in my professional career, I've actually changed hats many, many times. So I started in Australia in the industry as an ANZ banker and did that for many decades. And I was absolutely passionate about one particular area of risk management, which is what I did a lot of, which was managing the risk of low financial literacy. So we actually started doing a lot of work on financial education because we thought that that was the best way to engage our staff and our clients to understand money better. And as a part of the work that I was doing, I was absolutely fascinated by how different cultures view money, in particular Aboriginal Australia. So I did quite a bit of volunteering work with First Nations foundations. We designed the first financial literacy product called My Moola with them. I also was seconded to Reconciliation Australia and discovered that there was actually not much evidence on Indigenous views on money. So I packed up my banking career and changed hats and went into academia, did a PhD on Aboriginal views on money and what that means for financial capability and well-being, which is an area I was passionate about. And after I finished that PhD, I decided that there was a need to actually have safe and affordable finance for people on low incomes because there's a gap in the market. And as many of you have noticed, that was actually filled by payday lending, which can often be high cost and exploitative. So we created Good Shepherd Microfinance, which is now a microfinance provider in Australia, providing safe and affordable loans to those on low incomes. I worked with Good Shepherd Microfinance till December last year, came back from a Fulbright scholarship and decided to set up my own shop as a social entrepreneur. So I started 2020 as a social entrepreneur. Couldn't have chosen a worse time to set out on my own. But in many ways, what I'm passionate about and the common thread that runs through all these roles, which I've quite deliberately chosen, is to use research and evidence to influence action. So in many ways, the work that I'm really passionate about, which is about building financial resilience, could never have been more important in today's environment. And I'm hoping that I can bring together the research and evidence on money that I've gathered from all of these different sectors to find ways of having a really true cross-sectoral approach. So that's what my discussion today is going to be about. But, as a true academic, I thought, let's kick off this session with some interaction and some research. So Johnny, I hope you can put up some questions for our participants to participate in designing this session by answering some questions.
Yes, absolutely. Do you want to ask the questions of the audience and then I'll put them up on screen?
Sure. So I had two questions that I'd like you to answer. The first, how many of you would have $500 available in cash to cover an emergency expense if you needed it today? And the second was, would you have $5,000 available to cover an emergency? And I'd be really grateful if you answer that question for me.
Great, that poll's up now. Everyone's voting furiously.
Thank you. Thank you so much, Johnny. Any excuse to get good data.
It's also fun to hear from the audience. I'll give it another 5, 4, 3, 2, 1, and I'll just stop that and I'll share the results with everyone.
Okay, great. So we have 96% who've said yes to $500 in an emergency and 80% who've said yes to $5,000 in an emergency, which is great. And I'll come back to that in terms of how that's useful. All right. So when I started my career, more than 2 decades ago, here's me showing my age, I was told that banking products and services are designed to help our clients to transact, grow, and protect their money. So since there's a lot of discussion on designing financial products, I thought this might be a good way to start. So how can we explain what this means through a practical example? So let's look at Farmer Joe. as a client of the bank, he uses money on a regular basis for his household and his farm. He might do some interstate travel before COVID shut him down. But these kind of regular expenses, he needs to have a banking account where he can transact, deposit and withdraw cash, make payments. Once in a while, though, he has to cover a larger expense. It could be a wedding or a child's education. To afford these, he can either save up or take out a loan or plan an investment. These are grow products, allowing him to increase the money at his disposal. Over the longer term, though, Joe will need to insure his home, contribute to superannuation, set up a retirement plan. These are products which are designed to protect his assets. So that's what Transact, Grow and Protect means. But a banker's job is not just to provide Joe access to the financial products he needs when he needs them. It's also to help him to build financial resilience. What does that mean, I hear you say? It's the ability to recover from a financial shock. Now, anyone can experience a financial shock, but the consequences are most severe for those who don't have a buffer to fall back on. And that's why I asked you those questions. So our own little survey showed that 96% of the audience has $500 available in cash to meet an emergency expense. But a national survey actually shows that between 20 to 30% of the population across Australia does not have this available. We also found that 80% of the audience have $5,000 available should they need it. Now that is just under 1 month's average household expenses in Australia. And again, the national population shows that between 30 to 40% of the Australian adult population may not have that available to them. So what that tells me is that not everyone in this high income, high developed country, Australia, the lucky country, actually has an adequate buffer available in case of a financial emergency. So just like Stephen was talking about mental health and physical health and how important that is, to me, what's really important is financial health. And that's what my process and everything that I'm doing is all about. Now, longitudinal research, which is all obviously what we fall back on, from NAB and the Center for Social Impact, which they've done since 2015, so we have 5 years worth of data now, actually shows that 2/3 of the population in Australia has low financial resilience, low financial health. 2 million experience severe to high financial stress and vulnerability, and 10 million have a low level of some sort of financial difficulty. Now, the research also shows that one of the bigger barriers is that financial products, the ones that we transact, grow, and protect with, seem to have become very complicated. Half of the adults say that they don't understand these financial products and services. 1 in 10 says they have no understanding of these products. And 1 in every 4 finds it difficult to access these products when they need them. So as bankers, there's quite a bit to learn, isn't there? The groups which are most likely to have low financial resilience are those on low incomes, the women, and the young. These are the very groups that I was dealing with in Good Shepherd Microfinance. And so, obviously I have a lot of interest in protecting these groups. So what are the key drivers of financial resilience? The research shows that there are 4 drivers which together determine Joe's ability to recover from a financial shock. The first of these is that he needs access to a basic set of financial products and services which will help him to transact, grow, and protect, as we saw earlier. But in addition to that, he also needs to have the capability to use these products confidently. He needs to know what's available, he needs the confidence to use these, and the motivation to develop positive financial behaviors. Now, these are a bit of a bugbear for many, many people, but it's really important to have positive behaviors. And one of the special ones is knowing where to go for help. But even if Joe has access to the products he needs and the capability to use them well, he still needs to have the economic resources in order to recover from a financial shock. He needs a regular income, he needs to cover his expenses, he needs to be able to balance the savings and the debt that he has. And one of the most important factors is that he needs to have a buffer to fall back on in case of an emergency. And as we saw, many of our population don't actually have that buffer available. So these 3 factors, I think most of us could have guessed, you don't need to be an expert or do much research, would be important for financial resilience. But the 4th factor actually comes as a bit of a surprise to people as being important for financial health. And this is social capital. Joe's connectedness to others, his awareness of the supports that are available across the community, government, and society, and his ability to access these in times of crisis are important factors which are going to impact his ability to recover from a financial shock. So that's quite a useful piece of research to tell us what is financial resilience, how many people in Australia did not have this even before COVID hit us, and the factors that drive this. But what is Joe going to do now that an unprecedented financial shock such as COVID has come along? In addition to health, as we know, this has taken a wrecking ball to every one of these factors we've just gone through. Employment, household consumption, consumer confidence, our national GDP, all of these have been really badly impacted. And worst of all, the ones who are more likely to suffer are those who are most vulnerable to low financial resilience to begin with. Those on low incomes, the young, and women, because they are likely to be in the employment sections which are most badly impacted. So what are we going to do? Given that I started this year as a social entrepreneur wanting to help in financial resilience, how am I going to piece together all of the information that I have from the different sectors in order to reimagine how I can help Joe to build his financial resilience in a post-COVID world? That's what I'd like to discuss this morning. Well, when in doubt, like Hermione in Harry Potter, I sometimes run to the library. So I started looking at what is the research frameworks for building financial resilience, and there are a million out there. Starting from academia to industry, there's even non-fiction from Brene Brown, one of my favorite writers. So all of them have different views on what you can do to build resilience. But if I strip away all the differences, I can see that there are 3 essential steps that they all agree Joe needs to take in order to become more resilient. First, he needs to understand and refocus on the new normal that he now finds himself in. Second, he needs to refresh his plans. And third, he needs to restart his financial life, not just to endure the shock, but really to be able to build back better. So that's a framework I feel is a pathway to his financial resilience. But how can he actually apply these in practice? That's, I think, an important factor. So next, I'm going to focus on what he needs to refocus on in the new normal. And like any good risk manager, the first thing that you do when you are in a situation of crisis is you look and acknowledge the threats. So let's focus on all the 4 aspects and the drivers that we talked about and look at what are all the threats that Joe faces in this current situation. Well, the answer is not pretty. Joe's ability to keep his farm going, earn income, have some savings left over, transact, grow, protect, know where to go for help, know what supports are available, all of these have been impacted. Social isolation and uncertainty about the future is eating into social capital, and frankly, his financial resilience is being severely tested. So let's take a deep breath. The first part of recovery is to understand what the threats are. But the second part is to then look at what opportunities present themselves, even in the middle of this crisis, and there are many. Firstly, as you might have noticed, banks, insurers, superannuation, the financial services providers are easing fees and charges and making it easier to repay debts in many cases. The government and the community sector have taken quite a few efforts in the last couple of months, just like Stephen was talking about, to make sure that they're protecting jobs to the best extent they can, that they're supporting income, helping people with basic expenses, and helping to build some skills and capabilities in case they need to change their occupation. ASIC have relaxed the regulations so that more people have access to financial advice, which is affordable. And finally, we're hearing some great examples about how people are using digital technologies to stay connected, access the supports that they need, and find out about them. So refocusing in this manner, acknowledging the threats, but then looking for the opportunities, will allow Joe to take the next step of refreshing his plans. And one of the best things that's happened for me, I always look for a silver lining in the middle of this pandemic, is what many of us have talked about this morning, is a recognition that Joe is not in this alone, that we're all in this together. And to me, the pathway out of recovery for Joe is not just himself, but to recognize that he's connected to an ecosystem. And the pathway for me would be to enable every part of this ecosystem to take action to support Joe. So let's see how this might work in practice. We already know that Joe needs to take action in 4 different areas in order to have good financial resilience. But it's not just up to Joe. His close circle of family and friends also influences the way in which he manages finance. The socioeconomic circumstances of his household, the parents' familiarity with managing money when he's growing up. These are major influences on how Joe now manages his money. Financial stress that he experiences is also linked to the health of his family relationships. A breakdown in these in particular can lead to further hardship and even homelessness. So what does this tell me? This tells me that putting supports in place to support not just Joe, but also his family and helping them to maintain healthy relationships can actually improve financial resilience for individuals as well. Next, Joe lives in a local community, which also impacts his resilience. Living in a regional area means that probably Joe, it has reduced his access to financial products and services because regional areas have less access, physical and digital. Next, he's unlikely to have products and services which are specifically tailored to his needs in many communities. This reduces financial capability. And if the local area has a lack of economic growth and social cohesion, this too can increase his chances of facing further financial difficulties. So this tells me that in addition to managing what Joe needs to do and his family, place-based efforts to boost the socio-economic status of a community can actually improve the resilience of those who live there. But that's not all. At a national level, we know that inequalities in income and wealth, economic stability, regulatory and policy frameworks, all of these can have a direct impact on Joe's ability to manage his finances. These macroeconomic indicators, though, are difficult to shift. And in order to shift the dial on these, what we need to recognize is what's needed is a system change, which requires all the sectors, government, industry, academia, and the not-for-profits to work together. Now, this sounds simple in theory, but as Stephen has mentioned, it's very hard to achieve in practice without having a specific coordination body. And I'll come back to talk about this. But it doesn't even stop just at the national level. Global economics also make a big difference, as we are realizing with the global financial crisis and now COVID. Factors such as market stability, risk, competition, and even migration have an impact on the way in which we manage finances. So this tells me that maintaining global connections and networks so that we can all share ongoing learnings with one another is an important enabler of financial resilience. So how can I piece together all of these bits of information to help Joe restart his efforts to build financial resilience? Well, let's take a look at that, which is step 3. Take small steps and repeat. And what are these small steps that Joe can take? Firstly, he can use this time to check the financial products and services that he holds to make sure that they are the safest and most affordable for his personal circumstances. He can proactively manage his accounts. I know this is a bit of a bugbear for people. People don't want to engage with money, but really this is the best time to look at things such as, have you set proper limits? Have you got adequate coverage? Are you taking advantage of digital set and forget options that many financial services providers now have in place so that you don't need to remember to take action? It can be done for you automatically. And these are all the ways in which he can make sure that the product set that he has is the most safe and affordable for his circumstances. He can also cultivate 2 behaviors which research shows have the maximum impact on financial resilience. Developing a savings habit, no matter how small, even if it's $10 a week. It's a really great habit to build resilience. And the second is avoiding credit for daily expenses. He can shop around and compare best deals that are available between providers, and if possible, seek advice. In addition to this, he can take efforts to improve his economic resources. He can diversify his income sources, prioritize spending on necessities, arrange to pay bills and debt as far as possible to reduce costs, and if possible, build an emergency fund. And the research shows that typically that should be between 3 and 6 months of household expenses, which we saw already this morning was about, say, $5,000 a month, which is quite a bit of money to save up. Last but not least, he can proactively build his networks, both social and work-related, so that he can ask for help when needed. He can cooperate with local groups, sharing and pooling resources, and he can find other opportunities to take collective actions with others. So that's great. We've thought of a number of things that Joe himself can do, take small steps, and then repeat this till he finds his way out. But as we said, it's not just Joe. To me, the most important part of this is to enable every part of his ecosystem to also play their part in supporting Joe in this journey. Financial services providers can work on more inclusive design and delivery, particularly catering to micro needs, small needs. They can support small businesses, which is the engine of growth, and they can leverage technology to nudge and remind Joe to stick to his positive behaviors by helping him set goals, making sure that he's achieving them, and reminding him when to pay bills. Just simple things like that can make a big difference. Organizations from all sectors can also help by building the financial capability for their own clients, for their staff, and the wider community that they partner in. They can improve their support for those facing hardship, and there's going to be many of those in this COVID environment. Workplaces, both small and large, can look for opportunities to provide pathways to jobs for people, job sharing, finding gig economy roles. They can improve workplace skills of those who are ready to enter into the workplace and support self-employment, which very often for the groups we mentioned is the only pathway because many of the mainstream jobs are not available to them. And last but not least, as many of the people have talked about this morning, COVID has improved the flexibility, networking, and collaboration that's happening right now. Let's not forget that once COVID is behind us, and find ways to take cross-sectoral action so that we can achieve that system change that we know is going to be needed. So to me, by continuing to work together during and after this crisis, we can truly shift the dial on building financial resilience in Australia. And the one thing, from my point of view, that my organization can do going forward is to help everyone to take this action. And that's enough, I think, of talking from me.
Thank you so much, Vinita. That was amazing. There's so many messages going on how beneficial these talks are and how much, yeah, exactly. It's just coming through right now. I was curious, you spent, years of research to get to this point, and it's about turning research into action. And so I love this last slide of how you can take action. Based on the polling from the beginning of the talk, it seems like a lot of the attendees are individual contributors or team leads and managers. If we talk about systems change, how does an individual person, in a team, how do they help make that change?
So to me, and in my many roles that I've had in different sectors, it takes what it takes is one individual who's willing to pull together a whole team of cross-sectoral support. No one individual can solve the problem. If you can find ways to identify who in the ecosystem is best equipped to take action and then bring those stakeholders to the table, it is possible to then get more or less of a holistic response and make a start to achieve the system change that we need. For example, way back in 2007, I set up a national cross-sectoral network to work with the community, government, and the financial services industry to look at financial inclusion for Indigenous people. We came up with a whole series of actions that all of us could contribute to, each sector sticking to their own strategic priorities so that it's something that they embed into business as usual. And I'm very pleased to say that all those years later, many of those partnerships we set up at that time are still in place. Many of the policies and processes we set in place are still used. So the key to me is to find those in the ecosystem who can take the action, make sure that the action that you're allocating to them sits within their own strategic priorities so that it becomes part of their business as usual practice. And that, for me, is the best way of enabling system change.
Yeah, that's amazing. Ooh, I think I have some feedback. It links quite closely to what Steve and Isso had just talked about, that courage to try, that courage to find those networks and connections. You spoke about building that social capital. Who do you think is best placed to make those connections?
Well, you know, like Stephen mentioned, you know, I think I'm one of those people who just sticks my neck out and is willing to give it what I call a try, test, and learn methodology. Just give it a shot. If you look at each of the sectors, my time, you know, working in different sectors is that each sector has its own purpose, right? So the commercial sector is there to be able to engage in commerce and make profits. And there's no need for them to apologize for that. That's important. You know, you need to do business. The government is there to be able to protect sovereign risk and help the citizens. The community sector is there to work with people who fall through the cracks. And the academic sector is there to educate people and to do research. So to me, the best way to connect these is some sort of a hybrid between those whose job it is to look after others. So to me, it's a hybrid between the community sector and the academic sector, so that you really have strong evidence-based ways of supporting those who need your help. So very often these initiatives, which are cross-sectoral initiatives, have been set in place by a combination between academic and community sector leaders, but definitely involving every single other sector so that everyone can play their own role. So if you ask me who's in best place to lead this kind of work, I'd always say it's a hybrid, just like the CRCs do, between research and action.
Great, thank you so much. Oops. Are you guys getting that feedback? Thank you so much for just sharing such an inspiring talk and setting an example for all of us on how we can, you know, work across our industries and sectors to share our learnings together to make this impact. So really appreciate your talk and time today, Vinita. Thank you so much.
No worries. Thanks for having me.
Thanks.